It's been a rocky year for Netflix with shares down about 60% year to date, but the company's new ad-supported business model is giving Wall Street a reason to be optimistic. This morning, the stock got an upgrade from market perform to outperform from Oppenheimer, and last week, Citigroup raised its price target from $275 to $305. Let's talk more about this with Citigroup analyst Jason Bazinet. Jason, good to have you here with us this morning. All right, so it's so much focus on the ad tier model and the timeline of that being pulled forward. That's really giving some fodder for optimism here. But how is that reflected in not just the stock price move that we've seen most recently, but what the expectation is for how they will capitalize on that and for it to be accretive to their business and the timeline around that too?
Well, I think most people expect the ad tier to launch later this year. The question we're getting from investors is a simple one, which is how much revenue can Netflix generate in advertising for every customer or household that signs up for this? The question we haven't been getting is how many subs will that ultimately translate into? And to do that, you need a demand curve for Netflix. And when we went through the math, it suggests that this ad tier should add something like 65 million subs on a global basis. That is incredibly important because if you think about Netflix from 2010 until I'll call it the fourth quarter of 21, Netflix was adding about 20, 25 million net adds a year. It was viewed as a growth stock. Where we are right now is they're not adding any subs and there's no real free cash flow. And so Netflix doesn't have a natural shareholder base. It's not adding subs, so it's not a growth stock. It doesn't have a lot of cash flow, so it's not a value stock. And the thing that's exciting, I think, about this ad tier, if our numbers are right, is if 65 million new customers signing up for this is right, we could go back into growth mode, right? If the company starts adding 10, 15, 20 million subs a year, that would sort of excite the growth investors.
Yeah, it definitely would. If indeed it gets back up to those levels. For now, I was just taking a look at the stock. It's up about 44% from its lows back in May, but it's still down 60% on the year. But you're certainly not the only person lately who's been enthusiastic about the stock, Jason, based on the ad-supported tier. We've seen a lot of analyses come out in the last week or so. Yeah. I know I'm way early to ask this, but is there any risk of people getting too ahead of this and too enthusiastic in advance of this offering coming out?
Of course. I mean, the street could get too enthusiastic. I would just say, investors are in a pretty dour mood anyway. So I think that's going to sort of temper investors' ability to get in over their skis. So I wouldn't say those risks are very high. But as this plays out, of course, it's possible the market overshoots. I think the thing that gets me animated about this security right now is it's not really controversial if you ask institutional investors whether the ad tier is positive. I mean, if you don't have an ad tier and you're launching an ad tier, it's going to be positive, right? The trepidation on the part of the buy side is many of them say it's going to take too long. I can't buy this stock now, have them launch it in the fourth quarter. Then we're going to have to wait a couple quarters to see whether it works or not. And to institutional investors, that means you have to wait a year. And so investors aren't that animated about it right now because, that's a long time for a lot of the fast money funds. I look at it exactly the opposite. I'm like, no one's really interested in this stock right now. It doesn't have a natural constituency. Now is actually the time to be buying it.
How critical is the ad experience and how it's actually run, whether that's pre-roll, mid-roll, post-roll or something, or even giving consumers the ability to kind of decide how they're engaging with ads in this platform to get right for them to actually see people not just want to opt in on that initial kind of rollout of it, but even what that net promoter score might look like or that word of mouth marketing for the individuals who do sign up, who are the early constituents that decide to enroll, and them saying, yeah, it's not a bad experience.
I think in an era like this, where inflation is running at levels that we haven't seen in 40 years, right? I think much more of it is about how low the price point goes. And much less of it is actually about the type of ad experience that the consumer gets. I would suspect that, Netflix has a history of sort of testing and learning and going slow. And so I think whatever you see in terms of the ad experience early on is probably not indicative of the terminal year answer. We've seen this with YouTube as an example, right? Where the types of ads, the quantity of ads, the number of ads, all those things have sort of changed quite a lot. It's a pretty dynamic market for a lot of these digital properties. The linear world is pretty static, right? It's been the same forever. But I think in the digital world, it could be pretty flexible. So it will probably change, but I don't think it's the dispositive factor for the consumer, for net ads, or even for the stock.
Citigroup analyst Jason Bazinet joining us this morning. Jason, appreciate the time and breaking down the expectations for Netflix going forward. We'll see exactly what the reception is like from the end user and the consumers once this gets rolled out. Thanks, Jason.
Thank you.